Welcome back. Let's focus on the cement sector then ahead of its Q3 earnings season. Goldman Sachs expects the Q3 demand to pick up after a subdued showing in the first half of the fiscal. They remain skeptical though on price hikes due to the capacity coming on stream. To discuss this and more, we have Mr. Pulkit Patni, the India Industrials Analyst at Goldman Sachs, who joins us on the show. Hi Pulkit, good morning and good to see you again. Well, I was going through your note and you're sounding a little bit more optimistic on the volumes front, at least for Q3. That said, getting into Q4, what kind of assumptions you're making, both on the volume parameter front, because there will be that risk, right, of the year-end phenomena of pushing through volumes that will actually weigh on pricing. So your expectations on both volumes and cement prices from here on.
So, good morning and thank you for having me. I'll rephrase that a little bit. What we are expecting for the industry is to look at a weak third quarter from a profitability perspective. From a volume perspective, we've been actually positively surprised that what started off as a weak October picked up at the margin in November, and December volumes have turned out to be really strong. So I would expect that momentum to actually continue all the way till the end of the fourth quarter. So we are pretty optimistic that volume from here on should pick up. The other piece that we've touched upon is that we've seen early signs of some attempts of price increases, and we do think that at the early part of fourth quarter, which is now, anytime, we expect price increases to be attempted. To the point that you made, absolutely, towards the end of the fourth quarter, given that everybody pushes volume, we do expect some bit of impact on pricing to be negative. Net, we expect a weak third quarter because of prices and a much better fourth quarter supported by both slightly better prices as well as better volumes.
All right, Pulkit got that. Pulkit, in the next couple of years, the EBITDA estimate that you're working with for the industry is expected to improve by around 200-250 rupees per ton. So what are the assumptions you're making both on pricing, volume, and I think input cost or the measures that have been taking where various companies will help in cost saving? So how do you see this 200-250 rupee EBITDA per ton for the industry increase?
Sure. First of all, FY26, we have a pretty favorable base, right? This has not been the best of the year for the cement sector overall, whether it comes to pricing and even volume in the first half of the year. So you're working with a profitability number that's actually itself subdued. Now, when we look at the next couple of years, I'll break it down into two parts. The first part is the first part of the next 2 years, which is the next sort of 6 to 9 months. We do expect a lot of capacity to get added, which will have some negative impact on pricing. And to that extent, we do expect the first half of next year to see some subdued prices. Having said that, I think the bigger picture in cement remains intact, which is one, we expect demand to hover around the 7 to 8% range CAGR over the next couple of years. Secondly, we've spoken about this earlier, but cement is becoming a big boys club where the larger players are all working towards the cost, which is whether it is converting their power supply to more green power, more waste heat recovery systems, whether it is them working on logistics, converting road to rail, etc., and the overall operating leverage that is going to come because of the size and scale. For the industry, and especially the large players, to get to about 200 rupees EBITDA per ton improvement from here on is something that we think should be relatively easy. What will support in the process is consolidation, and that, I think, is going to be the additional lever for profitability improvement in the cement sector.
Do you think bulk of consolidation, though, is behind us? I think the top 4-5 players from ballpark around 50-51%, I think they moved to around 65%, early 60%. Bulk of the consolidation, though, is behind us?
Yes, the last 4 years have seen significant consolidation. We could still see more players coming in because ultimately it's cause and action, right? If you see cement companies not taking profitability or adding a lot of supply in the near term, there will be some small players who will feel the heat of profitability and there could be more coming in. Plus, I think what we have to fully appreciate is that the larger you are, the benefit of scale, size, cost come to you, and which over time will make the smaller players a lot more inefficient, in which case I would say maybe not the same scale, but you'll see consolidation as a theme may continue in this sector for a slightly longer period.
And what's the last accounted number when you talk about the big players holding most of the market?
We'll say we'll probably get to, as an industry, we can get to about close to 65 to 70% just with the larger players.
The top 5 players.
Yes.
How do the return ratios change now, in this sort of a scenario in terms of when pricing is a little bit weakish, though volume push is coming about? When normally you put up a cement capacity, I think the matrix was ROC should be early teens. That number could have dipped a little bit, right? So how has that changed of late?
In a cyclical business, you'll always have periods where when companies are buying capacities, their capital employed goes up and it takes time for them to improve efficiencies in the acquired capacities. The good news in the sector is that cost of acquisition has gone down from $140, $150 per ton to more like $100, and greenfield capacity expansions are happening anywhere between $60 to $70 a ton. So I would say while ROCs have been subdued in the cement sector for the last few years, we do expect with consolidation, those ROCs should actually start inching up. And somewhere, because the valuation in the sector, while it's corrected, it's still at the higher end of the range, is because market does expect consolidation to bring in better return ratios for the cement players as well. So we would expect, and we do have that in our numbers, that ROCs should trend up as utilizations improve over time.
All right. And geographic preference between the north as well as the south? The last many years, north has been doing much better. But now you have new players that are going out there. The capacity addition as well will be fairly high, while the south has been hovering around lower capacity utilization levels. So what is the preference geographically?
Absolutely. This is something that we have touched upon in our report as well. Yes, that north has been historically one of the best regions to be in. But given that bulk of the capacity addition coming from the large players, including entry by a few smaller players, is all happening in North India, we are looking at almost about 22 million tons of capacity getting just added in North India over the next sort of 18 months, which is why our preference would be for South and West. West as a region seems fairly strong, not much capacity coming in. Demand drivers, particularly real estate in cities like Mumbai, will be strong drivers. So yes, we do believe that North will see capacity utilizations dip down by about 600 basis points, and which could have impact on profitability.
Okay, all right. Final couple of questions then. The long-awaited merger was announced in the Adani Group between both those two entities, though they were almost operating as one. So the synergy benefits could be limited, though the management claims otherwise. Do you believe that this is a big kicker, or this would help them work as one, and ACC, Ambuja, Sanghi, Orient, all of them coming together?
Nigel, while we don't comment on individual stocks, the point that I made that consolidation in the sector will continue, and consolidation comes with its own benefits in terms of using limestone one versus the other. There are other benefits of brand exchange, etc. So that, I think, as a theme will continue, but I'd not be able to comment on company-specific situation.
Okay, and you would rather stick to the biggest cement player, going by your note, right? The big daddy, UltraTech Cement. People thought that the new challengers are coming in there, but the big daddy is your top pick.
Yes, UltraTech is our top pick in the space.
It's been good speaking to you, Pulkit. Thanks a lot for joining in. You've given us a fair idea with regard to how do you see demand, supply, as well as volume trends that will pan out. Appreciate you joining in. Look forward to chatting with you as 2026 does progress.
Thank you for having me.